But I always look at the market at whole. And if you're listening to this and you're trying to think out, how does this affect me? It's going to affect everyone, because what do you see in the next 12 to 24 months in terms of rates, and how is that going to affect not just your line of work, but consumers?
Sure.
And by the way, it's a leading question. No one has that true answer, but the Banking Association of America has an opinion, and I'm curious.
Yeah, so a lot of people have their opinions, right? Most recently, yesterday, the Fed met again and decided they're not going to raise their overnight lending rate, but they're open to raising rates again before the end of the year. The biggest thing is when the Fed raises rates, that does not directly affect mortgage rate, it indirectly affects them. So the second that the Fed says that rates will be cut, mortgage rates will more than likely drop. Just like when they say they're going to raise the Fed funds rate, the mortgage rates almost doubled or tripled over the last year when the Fed barely touched something. So that is a common misconception. The Fed raising rates does not mean they don't actually physically raise the mortgage rates. They affect overnight lending, which affects your student loans, your credit cards, your car loans, those kind of things. It's basically the overnight bank lending rate, which is, again, indirectly affects mortgages. Over the next year, as of yesterday, the new theory is the Fed has one more rate hike, which has put us to almost a 5.75 on the terminal rate. And they said now they're going to cut twice next year, not 4 times. And these presumptions are made out of what's called the dot plot. So basically, take every member of the Fed, they anonymously put a dot on where they think the rates are going to go, the Fed funds rate, and when they think they're going to cut. Before yesterday, they were factored into 0 hikes this year in addition, and 4 rate cuts next year. Market sold off a lot. Again, this stuff can change overnight. If that's being what that is being said is rates will be in the 7s for the foreseeable future, probably 6 to 12 months. Most economists don't think that. The Realtor Association does not think that. Fannie Mae. Most other economists believe that the rates will tinker down probably in the beginning of next year to somewhere under 6, and by the end of next year probably linger in the high 5s. Which in a normal market, if you do it historically, like the mid 5s are a good rate. Maybe not in 2020. But historically, if you asked 100 people, a 5's a fine rate. And that is the rate. What we think is, the make me move rate is probably 5%. If someone's at a 3% rate and they saw a 7 and I show them a 5 in a year, they'll probably be a lot more willing to move than they are today. And I think that's when the gridlock will stop and inventory will, finally start to recover some, is because people will move at that point. And they'll have enough equity and things like that. An off topic a little bit is, a lot of people ask, is the market going to crash? Should I wait? In 2007 and 8, the biggest difference was people did not qualify for mortgages. There was no doc loans. You didn't have to make a down payment. It's a wild, wild west is what we call it.
Sure.
Today, 2020, 21, 18, 19, whatnot, it's hard to get a mortgage right now. You have to be a very qualified buyer. In addition, when you're buying a home, like, a lot of these contracts that Matt writes and other realtors write, you're going over list price. You're offering cash for these appraisal gaps. You're very well qualified to buy a home, not only on paper, but also asset wise. These homes are not going to foreclose. They're not going on a short sale. People aren't letting them go. And they've also appreciated so much since they are purchased that even if when they sell, there's equity in them. So that's the biggest difference today than 2008 and 9. And I think people need more education on that to know that there's no waiting for this crash. Crash is not going to be there.
Yeah. And so the issue is there's so much information and so many news outlets that what you just said is not sexy in the sense that it's not going to get us 50,000 clicks when I publish that. It's like stability is here. That doesn't help sell ads or clicks. And the reality is it's like it's just like us coaching a client through this. I wish I could tell you in 6 months the prices are going down and rates will be cut by 2% and it's going to be so affordable. It's the best time in 2 months or 6 months or a year. That's unlikely to happen based on everything you just said. And the reality is, if it makes sense to buy now and you can afford to buy now at 7.5% interest, you should be purchasing if you need to. And you can always refinance in a year, 2 years, whenever rates do come down. And I always say, if we're totally off base and everyone's wrong and the rates go to 10%, you look really, really smart. That 7.5 sounds really good if rates are 10.
Yeah, and a couple other things with that is okay. So like today, a average money market account is between 4.5%. CDs are 5.5%. So if you're paying a mortgage rate of a 7.5, and you're making 5% of your money, the difference is 2.5%. That's not bad.
Yeah.
And people got to look at things that way too. Like in 2021, you're making 0% of your money. So when you look at the bigger picture, it's not just all about the rate. The biggest difference is home values are a lot higher than they were a couple years ago. So people are, they're looking at, hey, I'm paying more for this house. The rate's higher. It's costing me more. Gas is more. Eggs are more. Milk's more. So look at the total picture, and that is crushing a lot of people from buying homes. But yeah, if you can afford today to buy a home, I would highly suggest it. There's a meme I saw online the other day. It was like there's one person running at a 7.5% rate, and there's 3 to 7, and there's 5 to 6, and there's 20 to 5, and that's reality. When rates are 5%, which they, looking at cycles, they always go up and down. The market will be absolutely nuts. So probably nuts at 6% right now. And Maryland is seasonal to an extent. It is generally a little slower, and after the holidays, January, February, whatever, and then March really picks up. A little lag in the summer, then fall's usually pretty good. That will happen, but when interest rates drive it more than seasonality, as we saw in 2020 and 2021, even in 2022. So yeah, if you can afford it and it makes sense, there's no reason not to try it. And at some point you can refinance, and people think it costs a fortune to refinance it. It doesn't. If you stick with the same lender, generally speaking, we're talking a couple $1,000. Let's call it 2, 3, 4, $5,000, which is usually about a mortgage payment, maybe a mortgage payment and a half. And you don't have to pay it out of pocket. You can just roll into the loan. So when you buy a home, of course, there is more closing costs, but they're within reason now. So my suggestion is don't be scared of refinancing. A lot of people think it's this big, scary, bad thing. It's not. It's very normal. And to refinance a couple times, that's okay too. Because some people say you're at a 7.5 today and rates are 6.5 in 6 months. It's okay to take that and then refinance again to 5.5 in a year and a half.
Right.
Because you think about the amount of times why stay to 7.5 till rates drop to 5.5? The amount of extra money you're paying, you're literally throwing it away. So that concept, it's hard for people to get over. I would say education was better in that regards.
No one has, and that's a question I have written for you, is about education of the folks that we serve that don't have any basis of understanding of what we're describing. And we're speaking in generalities, but everybody's situation is different. So when I'm helping a first-time home buyer in the first, entry-level purchase price, the affordability is key. They're not thinking about their money market accounts or their CD rates. They don't have savings for all this. It's just like, I need to be able to afford a payment.
Yep.
And they say, well, I'm paying $2,000 in rent. So what do they say? I want to keep my payment at $2,000, right? That's like the first thing they say.
Absolutely.
And I want to own the home, but I want to pay the same or less than I currently pay in rent. That's it's all about the dollars, cash flow. Can I afford it? And then if you're dealing with someone who's affording their second or third house, and it's a move up house, $1 million house, very different conversation.
Yep.
And typically it comes back to their education and their experience level. And so I encourage people, if you're listening to this and you've stuck this far through, you're probably someone that's going to be more educated and understand what's appropriate and not appropriate given the market, and not be swayed by people that are screaming fire, 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 and you're running around crazy. I have some of the same clients that have been looking for 2 or 3 years with me that could have bought at 3% when prices were 20% less. And they're still looking because they wanted either perfection or that was too scary then. Do you remember how scary it was for some people when rates were low because they also thought the sky was falling then?
Oh, yeah. Yeah. It's all perception in that regards. And yeah, it's harder for people to swallow the pill now because, yeah, when they look at an estimate I sent them 2 years ago, they're like, oh my God, this is terrible. But everything's more expensive. So it's all relative. And also the first time home buyer thinks they need 20% to put down because their parents told them that. Because, 30 years ago, you had to have that. Honestly, on a normal loan these days, 3 to 5% is pretty normal. And there are, depending on, your income level and where you're buying, there are incentives for first time home buyers that can save them, a portion or sometimes all of their down payment.
And a great example, we closed on Friday with someone together with a buyer, and they put $500 out of pocket. This was a roughly $300,000 starter home. They put $500 deposit down, and they had a refund of like $300 at settlement.
Yeah, basically got in the house for free minus their home inspection.
Yeah, they paid a couple $100s to buy a $300,000 house out of pocket because of the grants you were able to find them and everything else. We were able to get seller help, it's called, from the seller, where they contribute a couple $1,000s, a couple percent back to the buyer. So there are still opportunities out there for people